Hello, students. Today we are going to learn part 2 of Sources of Business Finance, that is chapter 8 of Business Studies. Now let's study classification of sources of funds. So we can see that sources of funds can be divided on the basis of three things: on the basis of period, on the basis of ownership, and on the basis of sources of generation. Now, when we talk about on the basis of period, that is the time period, it can be long term, short term, or medium term. And on the basis of ownership, it could be owner's fund or borrowed fund. And on the basis of source of generation, it could be internal or external. So when we talk about the short term, we can say that on the basis of, if we talk about on the basis of period, long term, short term, and medium term. And under short term, we can see that we can borrow from the trade credit, factoring, bank, and commercial paper. Medium term, we can get loan from banks, from financial institution, from public deposits, and lease financing. Whereas in case of long term, we can generate finance through equity shares, through preference shares, debentures, retained earnings, loan from financial institution, and also from bank. And on the basis of ownership, we can have owner's fund, that is equity and retained earnings. On the basis of borrowed fund, we can borrow through debentures from bank, from financial institution, lease financing, and commercial paper. And generating fund on the basis of source of generation, as we said, that internal and external. Internally, we can borrow through equity shares and retained earning. And through external sources, we can borrow from banks, preference shares, debentures, lease financing, commercial paper, trade, credit, and factoring. So let's study one by one. When we classify on the basis of time period, let's talk about the long term finance. Now, it refers to the fund raised for a longer period, that is more than 5 years, minimum 5 years, and more. And it is used for investment in fixed asset like land, buildings, machineries, and which is required for permanent needs of the business. So, usually, long term finance is raised from shareholders, debentures holder, financial institution, and retained earnings. And when we talk about the medium term finance, it is used for modernization and expansion of business. So usually it is raised for a period of 1 to 5 years. And it is also raised from debenture holders, financial institution, commercial bank, and public deposit. When we talk about short term finance, it is raised for the period of less than a year, and it is used for meeting short term needs or requirements of the business, such as investment in working capital, like purchase of materials, payment of wages and salaries, or rent, etc., which are needed for day to day expenses. Now, when we classify on the basis of ownership, the first one is owner's fund or ownership capital. So it is the amount of capital contributed by the owner, partners, or shareholders, as the case may be. Like, let's say, issue of shares and retained earnings are two important sources of finance. Now, when we talk about the features of owner's fund, the first is risk capital. All the risk with regard to the enterprise lies on the shoulder of the owners, and hence their capital bears all the risk. So it is a permanent source of capital to the business, and no security is required because it provides the right to manage and control the business. And on the basis of ownership, the second is borrowed fund, which means you are raising the fund through borrowings, either through loans or through any of the borrowings like debentures holders or public deposits, financial institution, and commercial bank. So this borrowed fund is raised for a fixed period of time at a fixed interest rate to be paid even if there is a loss. So when you borrow from any of the sources, you have to pay the interest rate irrespective of whether your business is earning profit or loss. And it is a charge on the asset and no sharing of control in the management. Now, when we classify on the basis of source of generation, it could be internal or external. So, talking about internal sources, it refers to the funds that are generated with the organization or within the organization, like equity shares, disposing of surplus stock, retained earnings, etc. And external refers to those funds that are raised outside the business, like issue of debentures, bank loan, and public deposits. Now, when we talk about the choice of sources of finance, a business can raise fund from various sources. We saw that on the basis of period, on the basis of ownership, and many more. So, a business can raise fund from various sources by the way of issue of shares or retained earning, debentures, financial institution, commercial bank, and each of them are having its own merits and demerits. So, the entrepreneurs have to take decision regarding their choice based on their situation and purpose. Now let's understand what is retained earning or plugging back of profit or undistributed profit. Usually, a part of profit is transferred to the reserve every year and it can be retained or reinvested into the business for its modernization or expansion or for running the business. So reinvestment of undistributed profit is very good source of business finance. Like let's say for example, if your company is earning a profit of 10 lakh, you're not going to take away whole 10 lakh home. A part of that profit is kept aside so that you can reinvest into the business for further production. Like let's say for example, out of 10 lakh, if you have out of that 10 lakh profit, if you have kept aside 4 lakhs so that that 4 lakhs can be reinvested into the business for the further production in future. So that portion is known as retained earning or plugging back of profit or undistributed profit, which you're going to utilize it or you are going to reinvest into the business. Now, when we talk about the merits of retained earnings, it is more dependable than external sources. No dividend is to be paid and no cost of raising the fund, such as prospectors or advertising, and there is no sharing of ownership and control. And there is no security which is needed. So you can say that retained earnings has more advantage because you don't even have to pay the interest. So it makes the company financially strong. But of course, it has certain limitations. It may result in overcapitalization. It may create dissatisfaction among the shareholders because they might not get the dividend because you are investing into the business out of your profit and not dependable in the year of inadequate profit. So the years when your company is not earning profit, then it is not a source of finance for you and you cannot blindly depend on retained earning because the profit may fluctuate in the future. Thank you very much.